Welcome to our journey into the dynamic world of real interest rates. Today, we're unraveling how these rates play a crucial role in shaping the movement of capital across borders. So, what exactly are real interest rates? They're the typical interest rates, but adjusted to account for inflation, reflecting the true cost of borrowing and genuine returns on investments. These rates form the foundation upon which international capital flows are built. They dictate the attractiveness of a country's investment landscape to foreign investors, guiding the movement of capital globally. Real interest rates are more than just figures, they're signals. A country with higher real rates can attract foreign investments more effectively as investors chase those superior returns. It's not just money moving across borders. It's strategic financial decisions influenced by global macroeconomic factors. In the coming segments, we'll delve deeper into how capital flows are driven by interest rate differentials and explore strategies like the carry trade. Join us as we connect the dots between interest rates and the global economic fabric, preparing you for your AP Macroeconomics exam. Let's delve into how capital flows are influenced by interest rate differentials. These differentials represent discrepancies in interest rates across countries. When an investor identifies a more attractive rate in one nation compared to others, capital begins to move, akin to a river seeking fertile lands. For instance, if the US offers higher rates than the Eurozone, investors are inclined to funnel money into US assets, anticipating better returns. This flow is a dynamic reality orchestrating markets globally. Historically, countries with rising rates draw increased foreign investments, affecting stock markets and currency valuations. Consider the late 90s as investors shifted funds from Japan, searching for more profitable returns. Essentially, the difference in rates acts as a magnet, pulling capital from lower promised lands to those with greater potential, guiding investor decisions worldwide. Understanding these flows not only offers insight into market dynamics, but prepares you to engage with global economies. As our journey continues, we'll apply this knowledge in real-world scenarios. In exploring international finance, distinguishing between foreign direct investment, FDI, and portfolio investment is essential. Both are vital conduits for cross-border capital, though they cater to different facets of economic growth. FDI involves substantial commitments, channeling funds into physical assets like factories overseas, intertwining with a country's economy. In contrast, portfolio investment focuses on liquid assets, stocks and bonds, across foreign markets. Here, investors broaden their exposure, leveraging currencies and interest rates, heavily influenced by real interest rates accounting for inflation. Higher real rates can attract investors eager for better returns, directing international capital flow. Thus, real interest rates function as an investor's compass, guiding the exchange of capital globally. By understanding FDI and portfolio investment dynamics, students gain deeper insights into economic connectivity. Let's continue unraveling international capital flows, delving into strategies like the carry trade and illustrating global economic interplay pathways. Imagine a strategy leveraging global interest rate disparities to earn profits. This is the essence of the carry trade. It's a fascinating financial maneuver. Picture Japan, where traditionally low interest rates prevail. Investors borrow in yen at minimal rates to reinvest in countries like Brazil or Australia, where rates are historically higher, yielding profits from the borrowing-earning differential. But the carry trade isn't just about numbers. Currency fluctuations, exchange rate changes, add risk. For instance, borrowing yen to invest in Australian dollars involves potential rate shifts affecting returns at cash out. Yet for many, potential gains outweigh risks. The Japanese carry trade exemplifies the global interaction of interest rate differentials. Pursuing profits requires economic and real interest rate understanding. The carry trade capitalizes on small differences that aggregate into substantial profits, reflecting an art form in international finance. As we venture into international investments, understanding the interplay between exchange rate risks and capital mobility is crucial. When investors move capital across borders, they face exchange rate fluctuations that can boost or diminish returns. Imagine returns soaring only to shrink due to unfavorable currency rates. This unpredictability introduces risks needing careful management. Moreover, capital mobility's role is pivotal in money flow ease between countries. High mobility allows swift cross-border actions, capitalizing on economic shifts from varying rates, yet this agility can quickly alter market conditions affecting investment stability. AP Macroeconomics students grasping these concepts gain insight into international finance, paralleling real-life scenarios where these principles apply. In an interconnected world where capital flows like rivers across boundaries, recognizing exchange rate risks, dual threat, and opportunity. Alongside capital mobility readies you for informed decision-making in the global economic arena. Inflation may seem like just another term, but it plays a crucial role in determining real returns on investments. When inflation rises, it erodes money's purchasing power, impacting actual yield. International investors must adjust returns for inflation. Imagine investing in a foreign bond promising 5% returns, only to find inflation has cut those, leaving far less. Understanding inflation's effects is vital to gauging true investment profitability. International investors dealing with multiple currencies must constantly monitor inflation. Staying alert to these changes enables informed decisions, safeguarding assets from value loss. So, remember to factor in inflation. When evaluating investments, it could significantly alter your ultimate payoff. In the aftermath of the 2008 financial crisis, interest rate dynamics reveal much about capital movements. Examining the US and Eurozone comparison, both faced economic challenges yet diverged in monetary responses. The US, with aggressively lower rates, encouraged borrowing and investment, attracting capital influx. Meanwhile, the Eurozone maintained higher rates under different pressures, creating a unique landscape. Investors sought favorable US returns. This highlights a critical international finance aspect: how interest rate differentials steer investments and dictate global capital rhythms. Analyzing these trends helps students understand policy decisions and anticipate international capital movements, a vital economist's skill. Thus, post-crisis interest rates offer lessons in global capital navigation. As we conclude our exploration of real interest rates and international capital flows, let's revisit the critical ideas. We covered real interest rates, key in determining true investment returns once inflation is considered. They drive capital flows, facilitating funds movement across borders, largely influenced by interest rate differentials. Understanding these through FDI or portfolio ventures is essential for grasping global capital flow. The strategic carry trade illustrated interest rate exploitation with real-world insights from Japan's market. Navigating exchange rate risks and capital mobility also highlighted international investing complexity. Inflation's shadow over real returns is crucial for global investors. Lastly, our US versus Eurozone post-2008 crisis analysis cemented the intricate link between international rates and capital dynamics. With this knowledge, you can critically engage with AP Macroeconomics concepts. To expand understanding, explore our further lessons, all aimed at mastering your AP exams. Subscribe to AP Television for more enriching content and become an informed economist of tomorrow.